All eyes were on the Federal Reserve today as it made its latest decision on interest rates.
The Federal Reserve left its benchmark interest rate unchanged today. The Fed's decision comes as inflation is cooling. The current rate is at 3.7%, which is way down from last summer's peak.
Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks.
Mortgage rates are now over 7% compared to just under 3% 2 years ago, and credit cards are at a record high, nearing 21%. The average rate for a new car loan is 7.4%, the highest level since 2008. But the latest pause in rate hikes may be temporary. Powell signaled another boost could happen this fall if needed.
And that news sent stocks lower. The Dow Industrials fell 76 points. The Nasdaq was off 209 or over 1.5%. The S&P 500 lost 41 or almost 1%.
So what does the Fed's decision today mean if you're trying to buy a home, a car, or pay down some credit card debt?
Moses Altsech from the UW-Madison School of Business is back with us. Welcome.
Hi, Moses.
You've been out of town
you.
for a while. Good to see you. So what does this interest rate fluctuation mean to everyday consumers?
Well, you have to consider that the Fed, in addition to keeping the rates sort of where they are, they also sent out a couple of signals. First, there may be a further increase, but a further increase. And then we do expect interest rates to start declining. It's just that they will not decline as quickly as perhaps we would have thought. It's going to be a slower rate of decline through the next year. Now, what does that mean for people? That means that for the time being, mortgage rates, for example, are not going to go down. When they start going down, they're not going to go down very, very steeply or very quickly. The same thing goes for your credit card rates. So, there's a lot of people who are thinking, so should I wait to buy a house? Should I wait to, I don't know, get a new roof or a new siding?
For the interest
rates to go down, right? But the thing is, we have to consider two things. It's not just the interest rates. It's also the fact that prices, home prices, are not going to come down. The price of siding or shingles is not going to come down. Prices are going to keep going up. So if you wait long enough for interest rates to decline, maybe a couple of years till they're at the rate where you'd really like them to be, you'll still end up paying more because the prices would have gone up. For certain capital purchases, like buying a house or a big purchase like home improvement purchase or whatnot, the idea is that you can buy now before prices go up any further. They've gone up enough, Lord knows. But you can also refinance later on. So if you have a higher than desired interest rate right now, don't worry, you can refinance. I mean, my interest rate was higher than I wished, and interest rates dropped, and I refinanced my house. And I think it's important to remember to do that. So, and now is not a time to pay off your mortgage.
If you have a low
mortgage, yeah, that's right. If you have a low interest rate, if you got it at 2.5%, 3.5%, now you can put your money in a savings account and actually get more interest than that. So
short-term CD, you get 5%.
That's exactly right. So you might as well, if you have a low interest rate, just keep paying what you're paying and don't pay it off right now. Being debt-free is not always smart. It depends on how cheap the debt is.
Absolutely. And it's expensive right now.
That's exactly right.
Moses, great to see you again.
Good to see you, Moses.
Hey, it's my pleasure to be back.